My name is Arijit Sengupta. Very glad to kick off this panel. We have some awesome panelists and looking forward to the discussion on the state of VC in Asia. So we're going to cover a bunch of things in the 35 minutes we have. But before I sort of kick off, I will just briefly introduce myself and then ask the panelists to introduce themselves. They all have varied and very, very impressive backgrounds, and so I'm sure it'll be a great discussion. So my name is Arijit. I'm a general partner at a firm called B Capital. We invest in tech, in growth equity, VC, and some late stage. We manage about $6.5 billion of AUM, and it's a global firm. My role is primarily to work on portfolio value add. Before BCAP, I spent 20 years as an entrepreneur in the US and Asia building businesses with private equity. So with that, let me ask Melissa to introduce herself.
Thank you, and thank you for having me this morning. I'm Melissa Guzy. I am the managing partner of Arbor Ventures. We're a global fintech fund.
My name is Vishal Harnal. I'm the managing partner at 500 Global. We do a full stack investing, started our bones doing early stage, but now do the full spectrum. We invest all across the world. Main regions are North America, Latin America, the Middle East, Southeast Asia, East Asia, emerging Europe, and we're about to start sort of like a practice in other parts of the world as well. Nice to meet everyone.
Hi, my name is Kelly. I might be a little bit toned off today because I've been speaking a lot yesterday. I'm Kelly, one of the founding partners of Choo Global Ventures, who is a Singapore-based venture capital fund. We invest globally only in serial entrepreneurs because our fund basically is made out of serial entrepreneurs investing in other serial entrepreneurs. We invest in everything from AI as well as into Web3. We've been investing in AI since 2011 and as well as in blockchain and Web3 since 2016. And we love disruptive companies and we love serial entrepreneurs who are trying to disrupt the industry.
Thanks, Kelly. So let me go all anti-tech to start. I'm going to quote a line from Charles Dickens, which I'm sure everybody's heard. It was the best of times, it was the worst of times. It was the age of foolishness, it was the age of wisdom, right? And when we look at the whole tech ecosystem, the VC industry, what's happening on the macro environment, I think it's fair to say that this is a time of enormous change and a lot of stress at a macroeconomic level for founders across the region. But it's also a time of great opportunity because some of the things that plagued the ecosystem over the last few years, no path to profitability, expensive talent, lack of focus on profitable growth, some of those things have started getting addressed automatically. So with that context, let me sort of kick off with a question to Vishal. What's your take on the state of the ecosystem and where do you see things progressing from here, especially in this region?
So most of my investing experience, actually all of my investing experience has been in a bull market. I started in VC in 2014. That's all I know. And all of the founders that we've invested in for the largest part, especially in this part of the world, that's all they've known as well. So the success, at least until sometime last year, the start of last year, was really based on not just opportunities in regions where we're investing, what can be built over there, but also as part of the broader macro economy and the bull market that we've seen, right? And the low interest rate environment that has been able to push it forward. The game's changed. It's very, very different. And I've had to learn. The industry in Asia, for a large part, has had to learn because many people haven't experienced it. There have been few folks who have seen it before and what the playbook is like for a bear market versus a bull market. So drafting that up, learning from experience, and then chalking it up as something that you now have gone through and can understand better, I think is one of the things that's happening in the VC industry. We were a little fortunate because some of my partners had seen this before, so there was some organizational learning that we could have from them in understanding how to switch gears. So that was very, very beneficial. And I think it's a sort of like, it's a time in history where the wheat is separated from the chaff during this time. Specifically, I think we're seeing, even in Southeast Asia, firm closures and fund closures taking place because you're just not confident in the ability to raise capital and the ability to deploy it in a market like this.
That makes a lot of sense. So, I come from a slightly older vintage, so I have, seen the 2009 downturn, a little bit of the 2001 downturn, and I know Melissa has been in this region since the mid 2000s. So, sort of following up from what Vishal discussed, Melissa, do you have some learnings for this audience in terms of how you're tweaking your investing model, and what is sort of the advice or the interventions you're doing in your portfolio companies to help them, so to speak, weather the storm?
Well, I'm actually even an older vintage, so I did live through the downturn of 2001. But I really would like to compliment Vishal. It's pretty rare to get on stage with another venture capitalist and say, I've only, invested and lived, seen this through a bull market, and I'm actually willing to listen and take advice from those that actually have been through prior markets. The 2008 downturn really was nothing in venture. I mean, this region snapped back in 3 months. I used to measure airline traffic from Hong Kong up to China, and Dragonair, you could look at it, declined, and 3 months later it was back. It was really very mild compared to what we used to jokingly call the nuclear winter of 2001 in venture capital, where you woke up one morning and capital just dried up and funds gave back money, and about a third of the industry shrunk. We're somewhere probably closer to that, maybe in between. This downturn has been incredibly stubborn to start, but we're there now, and 24 is going to be a pretty rough ride, at least for the first half. With that said, right, it's actually first job responsibility is to make sure that CEOs are cutting burn rates. There's realized that capital is extremely hard to get, and to make sure you have sustainable business models. And I always say hope is not a strategy. You got to have product market fit. The flip side of it is probably there's no better time to start a company because talent is less expensive. You're starting a company in a time where you have to be frugal. You have to find product market fit and have that discipline, and you don't have the frothiness of the market to save you and cover up really a lot of the mistakes or what I would say, we're only a year away from this or that, but you have to really demonstrate capabilities a lot sooner. And Vishal, your willingness, anytime you would like, I'd happy to have a coffee with you and walk you through at least what we've done. But, with that said, we did send out a letter to our CEOs and issued our quarterly reports last night, which is, all about sustainable growth, cut your burn rates. This is not a time for, excessiveness, but a time really to buckle down, because I think the first half of 24 will be one of the toughest venture markets we've seen in probably the last 20 years.
Well, thanks for that insight and context, Melissa. Let me ask Kelly something, which I think is often on my mind. And at B Capital, we run global funds, so we invest globally. And I think one of the big trade-offs living in Asia is how do you balance the depth of capital markets and sort of the broader set of opportunities and perceived lower risk in more mature markets like the US versus Asia, where capital markets are shallower, experienced founders are at a premium, lots of opportunity. And I wanted to get your take, Kelly. I know you guys are based out of here, but you invest globally. So how do you look at this balancing act between Asia and the world, and in some of the sectors where there's a lot happening globally in AI, Web3, crypto? Would love to get your take on that.
Sure. Thanks, Arijit, for that question. I think one of the interesting things, sorry about my voice. One of the interesting things is in 2008, I was an entrepreneur before. Some say, I moved over to the other side or the dark side or whatever, but I think both sides are equally important. You have to have both sides to make things work, right? So I experienced as an entrepreneur in 2008, raising venture capital, growing the business, trying to understand how do I actually scale the business out of Singapore. It was a startup in 2008 that basically uses AI to understand what people are saying in Singlish, Manglish, Hong Kong English, and all the different variants of languages. And we raised venture capital. It was $2 million from one of the best, most respected VCs back then. And really, in 2008, there was really not much choices of venture capital. But what we learned very quickly was that, yes, money is very, very important, but the networks were equally important. And I remember that back then, my co-founder and my CEO basically told me, Kelly, because he's been a serial entrepreneur before, he said, Kelly, the money is great from a VC, but I think it's very important that the VC is able to open doors for us, right? So don't just take money for money's sake. And so that was in 2008. We started to grow globally. We had 12 countries, 300 people. We have clients in the US. LinkedIn was our client. Estee Lauder in UK were our client. I think one of the first few, at least in this part of the world that I know of, that started to go really global. And from that, I really understood, because I spoke to the VCs in those countries, and as well as the other founders, like what they thought about the tech industry. I would say that we were maybe 1 to 2 years behind in the US in terms of technology, in terms of how forefront or cutting edge we were. But we had the market. And if we had the market and we had to localize, I think that's one of the advantages that we have. And as a result, the company got acquired, and then we went IPO. So from that perspective, when I became a venture capitalist, before I became a VC, I became an angel investor, right? So I started investing. So I thought, okay, maybe as a okay entrepreneur, I now can invest. But I can tell you honestly, it was paying tuition fees, right? Literally, every startup that I thought was interesting, because I was not from that domain, maybe could make money. But I paid a lot of tuition fees because I wanted to learn, right, in terms of different areas like medtech, healthcare, and everything. Because I came from an AI background. And then when I joined True Global Ventures in 2015 in Fund 3, I realized very quickly that the network that I have was only strong in Asia, but it was never going to be as strong as some of my partners in Europe as well as in the US. So one of the things that I wanted to join True Global Ventures is because I wanted a network that is globally there, can source the best deals in the world. And back to the point about AI as well as Web3 companies, a lot of them can become global very quickly. They don't just play in one particular space, right? Because if you think about it, Web3 is almost borderless. As long as you have a wallet, you can implement this anywhere in the world. Whether it's in Africa, whether it's in Europe, whether it's in Asia, you just need a wallet, you're on, right? It's like a single sign-on. So the scale of these companies, of these startups, can go really quick. If you do not have the right partners in those cities to pick up the founders, you're going to miss the train, right? So I think that was one of the reasons why when I saw True Global Ventures as a fund, I wanted to join as a partner, because I felt that this could expand my network outside of Asia, into Europe, into US, and I really wanted the best deals in the world. I don't want to be just exposed to whatever I have here in Asia. So that's a little bit of the context in terms of what I felt. I would think, and this is of course very subjective. In the last couple of weeks, we had some debates with fellow peers, friends, and everything. We think that, for example, in the AI space, China is probably about 9 months behind in terms of AI, but that is only a perception, right? That's from the software perspective. From a hardware perspective, some people claim maybe 7, 8, 10 years. But all I can say is this: never discount the Chinese. They can do things that even you do sanctions on them, they can actually scale very quickly. So as a VC, as an investor, I'm always open and looking at how these trends actually affect our investment thesis, right? And yes, everyone else is behind the US in terms of AI, but they can come out really quickly, number one, and they can implement this AI into sectors that are very specific into that particular region. Just like my own experience when I started as an entrepreneur.
Thanks for that great insights. Let me change track a little bit. As we look at this whole new environment, I wanted to ask Melissa and Vishal to talk a little bit about how are they changing their diligence approach and selection criteria for looking at investments, and how much of that is customized to the Asian context, where there have been a few blow-ups which have been very visible in recent times of VC-backed companies, and is that pretty much the same globally, or is that very unique to the regional context? And Melissa, maybe you can kick off with your sort of thought on that, and then Vishal, perhaps you could add to that.
Well, I mean, we do invest globally, and blowups happen in every country. And I always laugh when people in the US think that they're better than everywhere else when it comes to behavior among founders or amongst the teams. I mean, blowups happen globally. I mean, we've seen the recent Vest2 blow up in Israel, which was pretty horrific. We've seen, you know, in the past maybe issues, I mean, in China. I mean, we never had any issues when I invested in my prior firm there. So diligence hasn't changed. I mean, we've always been extremely diligent about how we go about things and very measured. So we do 4 to 5 deals per year. That never changed in the frothiness of 19 to 21. We use a psychologist to analyze the founding team. It's something that we developed over the last 5 years with a pretty well-renowned psychologist who did a lot of work among founders globally. And the reason being is because as a VC, you're in a non-control position and you're backing people. And the most important diligence you can do is around the team that you're backing. Especially outside the US, it's virtually impossible or very, very difficult to swap founders or CEOs. And therefore, your relationships, I always joke, a relationship with a founder actually lasts longer than the average marriage does in the US. And so it's really a long-term relationship of trust that has to be built. And that means not always just being there on the rah-rah side, but also having those difficult conversations and having someone feel like you're truly a partner. So our diligence process hasn't changed throughout this whole time. And the bar is extremely high and will remain, you know, very high. I think what is interesting and what a lot of people forget to think about is what's the exit strategy? There are a lot of nice companies that are built and there's no exit. At the end of the day, you know, Alan Salzman, who was the founder of Vantage Point, used to say, someone's got to fall in love with this company more than you at some point in time. So on an M&A front, you either have to be in the crosshairs of when a company decides they need something and it's going to be cheaper for them to acquire it, or it'll take them years to get to that scale, or in a much more rare instance, you have a company that actually can go to the distance and go through the IPO process and actually survive the lockup coming off, which is pretty difficult, and then have something that's sustainable over a long period of time. I think the difficult aspect of now is thinking about exits. And we always think about exits because I believe in monetization. I like carried interest. I think it's an important part of the equation. But I think that's really difficult for people because when they do enter companies, they really do have a lot of hope that this is the next multi-billion-dollar company, and you're like, okay, how? Who? Like, when, what? And those are the things that have to be answered along the way. Or you fortunately sell out. You know, Vishal has very early stage. He can sell to people who are a little bit later, and we can then sell the growth funds who are private equity. Over here. So.
No, I think, you know, like someone had told me a long time ago that venture is a get-rich-slow game.
That's right.
Which is, you really need to focus on carried interest and the exits, and that's how you generate wealth. It's really not on any other metric. So our practice is quite interesting. We operate regionally, so we have funds that invest in various regions in different parts of the world. And we have an early stage practice, we have a growth equity practice, and then globally we have a special situations practice, so $100K to $100 million checks. And what's interesting is over the years, and I'll speak from my partner and myself, like two of us that invest primarily in Asia, we've always been very price sensitive. And I think that's a very nice way of saying we're cheap when it comes to investing. And that did us a huge benefit, did us a huge favor in the frothiness of 2019, 2020, 2021, where we did not invest in a number of opportunities, and this is not just us in Asia, but even in the rest of the firm, because we just couldn't see us making money on those investments in the longer run. We didn't know whether they were sustainable, and we just felt it was too expensive. So if you're a VC feeling 3 years of FOMO, of missing out on every other investment that is getting marked up and is in the news, and they've just raised a monstrous Series A or Series C from some marquee investor, it's hard to deal with. But we understood the dynamics of entry valuation very early and its outcome on what you make at the end of the day with funds. Right? We have 40 funds now all across the world, and so some of them have reached fruition. We understood that, and we're very, very glad. So how has the current climate changed the way that we think about investing? It hasn't. I think very similar to Melissa, the level of diligence is very similar to what it was, and we've stuck to our guns on price. Factor in, of course, that over time, price does increase, but it shouldn't increase so phenomenally that a seed investment is doing like 15 to 20 million post-money, pre-money raise, right, which is insane. What's even more interesting is how it's changed between practice groups. So I'll share something with you, and this is an active discussion that's happening in the firm, which is, especially over here in Asia, our early stage practice has a capability to do follow-on. But if you think about the market right now, we are likely to allocate more of that capital to first check investing and actually getting into increasing the size of the portfolio over the same investment period because we're seeing more opportunity there and really capitalizing those companies for longer duration rather than following on into opportunities a little bit later down the road. First, it's taking a little bit longer for those companies to gestate in this particular market and sort of hit product market fit. And so that's been pretty interesting. In the growth equity part of the practice, which is Series C onwards investing, our partners are going into deals alone, right? They're looking at what they can lead and where there's huge price asymmetry and value asymmetry in companies that are growing, but no one's willing to take out the checkbook. So it used to be the case that you form these coalitions of the willing, but I think it's getting harder to do now. And so having the steady hand to write that check into the company at growth is just becoming such an important skill.
No, great. You sort of took the second part of the topic, the viability of exits and how to sort of bake that into your investing strategy into the discussion, which in my mind is a huge topic. And I just want to dig a little deeper into the theme of exits. And I think Asia still has a few questions to answer because we don't really have a vibrant public market ecosystem here yet. We have had some examples in Indonesia. Hong Kong is starting to pick up again, and we've had a few in India. China, of course, is a much more mature market, but it's not great from a IPO standpoint yet. And high-value strategic deals regionally, if you look at the top 300-400 large corporates in this part of the world, they're not known for doing $2 billion, $3 billion acquisitions. And this is, not only in the growth equity space, this issue is felt, I think, in the private equity space as well, where the pace and the quantum of exits is lesser than more mature markets. So where is the path forward, and how should the investor community look at shaping exits? It's just a question of earmarking more time and more capital and plan for longer innings, or are there other ways of looking at exits? How do you guys look at it? So, maybe Melissa and Vishal, just following up from what you said.
Yeah, so I think this is a very important part because Southeast Asia has a problem here, which is the exit market. Because it's not only IPOs, it's also M&A. Given the structures of the companies in the region, they're unlikely targets for US companies who have been the most generous at buying or making acquisitions. So you're really limited to Japanese companies and Chinese companies who have been willing to acquire. If you look at the M&A market, there's been 5 companies of size. We've had 2 of the 5, right? And this is ex-China, but I'm actually including Japan in that we sold to PayPal for almost $3 billion, right? But then, number 4 is CDP, which we sold to Ant for about $600 million. That's it. There's no other exits. So what you have is this challenge. You have this challenge in the region of it being clogged because you have VCs now who have a bunch of portfolio companies. Who are you going to sell them to if the IPO markets don't develop? Now, hopefully with Rule 18C in Hong Kong, that will provide some market. But I think it's really a very valid question of how much money can the region take in venture if an exit market doesn't develop, and what is that exit market going to look like? Because M&A is limited as well as the IPO market. I think that's critical, and therefore we've actually cherry-picked across the region more than being widespread, because I am concerned that we need to see an exit market develop. Again, Rule 18C in Hong Kong could provide the solution to the problem, which is a tech market where companies don't have to be profitable, they don't have to demonstrate the 3 years of profitability. We've seen it used in a limited way so far, but that is the great hope for Southeast Asia. But the question cannot be answered at the moment and needs to be answered over the next couple of years. So.
I share that view. So in the portfolio in Southeast Asia, we've had, I'd say, 14 exits, three public listings. So Grab, Bukalapak, and Prenetics in Hong Kong, which is not really a Southeast Asian company, but we had invested from that fund. And apart from Bukalapak, even the range of companies that are now looking at exit, none of them are looking to exit in the domestic market. So they're actually looking at NASDAQ and NYSE as realistic options. Some are exploring European exchanges, interestingly enough. So insofar as IPOs is concerned, it's way thinner than we see, for example, compared to the US portfolio, where the muscle for acquisitions and acquisitiveness is a lot better built. Southeast Asia, that's exactly what Melissa said. It's just not a habit. It's not developed over here for any of the large enterprises or companies, and the US companies aren't coming in to buy it. So in the US, for example, we had one of our portfolio companies, Credit Karma, sold to Intuit for $10 billion. You're not going to have that size of M&A transaction over here. It's very, very hard. The best bet to actually increase the range and the frequency of acquisitions in Southeast Asia are actually the new tech giants that are being formed over there. I think if you're built from that crucible, it's more likely that you have a muscle and an interest to buy companies. So one of our partners that runs the growth equity practice over here, his specialty is actually M&A. And the reason why we brought him over is that he had done it for a few of the companies that we were on the board together with. We saw that work out pretty well. But you have to increase that range actively and prod that behavior, sometimes in an ecosystem, to make that happen. And it's true in so many emerging markets. You're just not seeing that, and it's so necessary to develop to actually get that forward.
I think you bring up a really key point, which is companies don't get acquired because one day somebody calls them. You have to develop these relationships a year, well, actually probably 18 months to 3 years in advance to set the stage. And we were in Grab too. The stock did really perform very well.
So just wanted to add to this point. So this is one of my favorite topics. How do you exit, right? Because you can invest in a company in the right valuation, but if you can't exit, you can't exit, right? And you basically don't get your payday, like what you said, because carry is, for us, is also very important. So one of the investments we did was Forge Global, which is a US-based company now listed, that basically is the largest private tech company, unlisted shares company in the world, right? So they have more than 8 billion, now even 9 billion of liquidity that's ever done. You can go in there, you can buy OpenAI, you can buy whatever is unlisted at this moment. And one of the research that was done was that startups are now taking longer to actually raise. So from 12 months usually in 2021, now it's about 21 months. So there are a few factors that we see, right? Could be because they raised a large amount in the previous rounds, but they're scared of the potential down round that's already happening. But what's interesting here is that in this space, you can, as a VC or even any other investor, exit through such platforms, right? You don't have to wait for a mega IPO. You don't have to wait for a mega M&A. You can actually sell a lot of these secondaries on such platforms. And I think there are tons of platforms now, including Forge Global and everything localized, right? Whether it's in Australia, China, and various other areas. So that's one form of exits that we see is potential for any investors. I think from a Web3 space, and I don't know whether you are familiar here, there are other parts of ways to exit. One of them is what we call the IEO, right, or ICO, which is to list your tokens basically in the exchange, whether it's on Binance or whether you list it yourself. So that unlocks the liquidity also for the investors. As for us, as a fund, we can't invest directly into crypto, but we can invest in the equities. And we would never say no to free crypto if let's say, for example, the founders want to give us some of it. And that also helps us, and our LPs has also unlocked some liquidity early on. So we don't have to wait for the usual 5, 8, 10 years before you can exit from a VC, right? Because I was talking to a lot of managers, yesterday, as well as also investors, and they were saying that, hey, are you liquid? Are you illiquid? The question is, in VC, people always see it as an illiquid investment. But to me, actually, there's some liquidity there if the VC itself invests correctly into this kind of other areas where they can exit through secondaries or actually through tokens if they have that mandate itself. So for me, I think this kind of exit path exists, and it doesn't have to be in Asia, because I think the best valuations are definitely in the US as well as in Europe. They definitely are, at this moment, it's not this part of Asia, maybe in China, but that has already corrected. So we think that companies that are global, they can exit anywhere, right? And we see a lot of trends in the Singapore companies. After the trend of Klaviyo, Instacart, all these IPOs that happened recently, Arm, right? We see a lot of Singapore companies, a lot of Asia companies also trying to go in the queue, right, to be listed in the US itself. So we see that some of this data coming in, that the IPO market may be returning compared to maybe in the last 12 months.
Thanks. No, one of my favorite topics at B Capital, we have an exit committee which actually focuses and puts pressure on the investing partners on why they're not progressing fast enough. And we have a team which is ex-iBankers, which is supposed to help portfolio companies plan for exits. I think we have less than 3 minutes left, so I'm going to change the format a bit. I'm going to do 3 quick-fire questions to all the panelists, and then we'll wrap up. Wow. Question number 1 is, on a scale of 1 to 10, your rating on optimism for the Asian entrepreneur VC landscape. That's question 1. Question 2, one mega trend or some sort of a macro thing that you see which shapes that rating. Question number 3, one piece of advice you have for entrepreneurs who are building a business over the next 4 to 5 years. 1 sentence each. I'm gonna hold you to it. Melissa, you want to go first?
Well, optimism. I'm a venture capitalist. So I'm always optimistic. 7, 8 for the region.
Great. What's your trend?
We're focused on the intersection of insurance and payments, really freeing up trapped collateral that's in the system, or creating new insurance products for novel risks.
One piece of advice.
For startups, hire the first 10 people very well and make sure your first 2 to 3 customers are worth chasing and actually spending the money on. It makes all the difference in the world. Success or failure starts with the first, really, 5 to 10 customers.
Awesome. Vishal?
Always an optimist, but I'm particularly optimistic during this time, so I'd say like an 8 on optimism. One of the, specific to this region, at least one of the areas we are definitely investing in a lot more and have been doubling down on that is agri-tech in general. And I know it's a little bit of an odd thing to say, but we're just seeing a lot of low-hanging fruit in those areas and opportunities for founders to build companies like eFishery. And the third question was advice for founders. One of the things we're noticing, and I think one of the best pieces of advice that I can give is understand the time frame that it's going to take to build a company better, because
it's not glamorous.
It's not glamorous. It's not fun. Even though this is the best time to be an entrepreneur and build a company, it's still not going to be an enjoyable journey. So you meet a lot of entrepreneurs who've had exit. You ask them, would you do this again? And many of them say no, even if they're successful, right? So understanding that dynamic.
Kelly?
I'm an optimist coming from the entrepreneur side to the fun side, so I'll say 11 out of 10.
Okay.
Why? Let me substantiate, because there are a lot of hidden gems in Asia. One of them is a unicorn that we invested into. When we initially invested, they were like $60 million valuation. Now they are close to $6 billion valuation. Web3, leader in the space, something that Asia can be very, very proud of. Animoca brands based in Hong Kong, right? Something that you will never see traditionally in a Web2 world or even an AI world at this current moment. So I think there's still a lot of hidden gems that's there. They are dominant in the space. We think there's going to be an exit. Regulations are also a very, very big part of it. Hong Kong, Singapore, even the Middle East is playing a part of it. We think this will grow in the next couple of years. Yep. So we will probably have to check back in the next couple of years to see whether we're right on this area.
Thank you.
Yeah. And tips to founders, right?
Yes, absolutely.
Tips to founders is I think you have to think global in this world of AI as well as in Web3. You can be global very quickly. You can execute locally at first, test out certain concepts, but the world is your oyster. You can essentially corner the market if you know your niche.
We did an entire VC panel without saying clean tech. That's epic. Look at that.
No LPs here, so we didn't find time for that. But thanks for an amazing discussion. A round of applause, please, for these panelists.
Thanks.